We are going to day 2 of the 52nd Regional Conference of SIRC, themed SIGARAM Breakthrough to Excellence, with 3 power-packed sessions by prominent speakers. So we'll start the day with ICA motto song. May I now request all the members to please raise for the motto song.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यतीतश्चन एतद्द्वैता 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 एतद्द्वैता.
We now have the chairman address by the chairman of SIRC of ICAI, CA Dangar Chand U Jain. Over to you, sir.
Yeah, thank you, MCs. I welcome you all to the day 2 of SIGARAM, the 52nd Regional Conference of SIRC of ICAI. Hope you had a great day yesterday. There were excellent technical sessions, and we had an inauguration by our Honorable Srimati Nirmala Sitharamanji, Union Minister of Finance and Corporate Affairs. And I'm sure you are enjoying the platform, the visual treat which we have give in physical treat absentia. Maybe in sometime in future we'll invite you to Madurai for yet another program actually. So I thank all the members for their kind cooperation, support, and I expect the same in the next 2 to 3 days as well. Today I would like to recall the 138th birth anniversary of Mahakavi Bharatiyar, who was a staunch Tamil poet, but his learning was so vast that he learned 32 languages. That's the big message he conveys, that not limit to small things. And I read a nice thing that if you learn one language, it is equivalent to leading one more life. And we have had this gentleman who had probably lived 32 lives or even beyond that. And he was the one who kind of spoke about the MSMEs or the empowerment of women, raised voice against casteism, which a few of them were rightfully touched by our chief guest yesterday. I would only like to start the day with a nice lines of his, which goes on to say that Ayudam Seivom, Nalla Kagidam Seivom, Alaigal Seivom, Palli Salaigal Seivom, which kind of in sync with what our institute is all about, with our ICA motto, Ya Eshu Supteshu Jagrati. Thank you. Wish you all a happy day 2 of the conference.
Wow, what a way to start the day, sir. Thank you so much. Now, may I now request CA Pampanna, Regional Council Member, to address the speaker, give the speaker introduction of the speaker.
Mr. Ronsara also have been appointed by the Ministry of Commerce and Industry and DS representatives and the governor on the board of Economic Research Institute for the Asian and East Asia in the November 2019. The appointment is for the period of 3 years. And other acknowledges Mr. Shah is featured by Indian Today, January 2000 edition, in the listing of 50 Indian for the next millennium. With this brief introduction, I once again welcome you, Rohan Shah, for this 52nd Regional Conference to address our members on the input tax credit and the legislative and prospective, sir. Thank you for joining us. And sir is from Mumbai, and welcome you, sir, on behalf of all the members present or through virtual mode, sir. Thank you.
Thank you, CA Pampanna, sir. We will now have the speaker felicitation. We welcome you, sir. Now may I request CA Rajendra Kumar, Central Council member, to give a special address.
Very esteemed chairman of the SIRC of ICAI, my very dear friend and younger brother, Dungar Chand Jain, DC Jain. Very esteemed faculty of this session, eminent advocate of India, Rohan Shah ji, other members of the regional council who are here amidst us, and all the members, 3,000 plus members who are registered and watching this digital event. On the birthday today of the national poet, Mahakavi Bharatiyar, I greet each and every one of the Tamils and those living in Tamil Nadu on this momentous occasion of the birthday of Mahakavi, the national poet Bharati. As chairman rightly put it, he was the one who started the social movement, which was rightly touched by our Honorable Finance Minister yesterday when she inaugurated this conference. Following this conference very closely, the arrangements in the last about 10 days or so, I'm convinced that it is the right occasion for me to rechristine our chairman from Dungar Chand Jain to Digital Chand Jain. So he will be known as not Dungar Chand Jain, DC Jain, we will all call him as Digital Chand Jain. The D is digital. He has remarkably transformed a physical event into a virtual event. And all the regional council members are to be commended for their greatest cooperation that they have offered in these most difficult times in humanity. As the chairman of the GST and Indirect Taxes Committee of the Institute of Chartered Accountants of India, New Delhi, all of you are aware of the giant leap the committee has taken in this year, with 17 publications and 4 more publications due to be released on 23rd of December this month. On the policy making, we have been constantly engaged with the government of India. You would have known the kind of words the Honorable Finance Minister used for us yesterday on the GST related matters, and how the Institute has been playing a very, very important role in the policy making as well as implementation of GST in the country. This committee is second to none in ensuring the ease of GST. This committee is second to none in ensuring that proper policy is made at each level to ensure that the GST becomes an easy tax. But I'll come to it a little while later. Chairman has given only 5 minutes, so I'll try to conclude within 5 minutes. The topic of today to be taken by Rohan Shahji is input tax credit under GST, legislative and writ perspective. When I think of or when I read of input tax credit, I always go back to the money credit scheme, the MODVAT credit scheme, the SENVAT credit, and what we have today, the input tax credit. And I've always been in doubt whenever I ask a question, is it the right of the registered person to take input tax credit? As has been in the European legislation, the right to take credit has always been a question that has been put before the tax authorities. Is it the right, or is it a facility granted by the legislature? GST, the consumption tax. Consumption taxes shall always be neutral. That is the principle. A tax paid by X is eligible for deduction when output tax is payable by Y. But friends, world over, in 150 plus countries where GST or VAT is being implemented in the manner in which India does today, being one of the OECD observer countries, the OECD model being followed, it has always been a question that input tax credit is not necessarily a right. the government can impose restrictions on taking the credit. I remember having addressed the Malta Institute of Management in the year about 2015 or 2016, when I was in Malta. In their international conference, a point was made whether input tax credit will be allowed for leisure, entertainment. Leisure and entertainment, these two things more or less are one and the same for us. Is it an allowable credit or is it not an allowable credit? Malta being a very, very small, tiny nation in the European Union, and the entertainment industry there, the yachting and the casinos form the major revenue sector for the government. So leisure, entertainment are two things which are embedded in the VAT law of Malta, and the government places restriction on entertainment and small amount of restriction on leisure to take ITC. I would not dwell much upon this subject. We have a very, very capable and very eminent, the founder of economic loss practice, ELP, as we know it today, who will be deliberating on this subject. More to come from our committee in the future, and more on this subject. We, as the members of this committee, and also as the chairman of the GST and Indirect Taxes Committee, I promise you that you will find us standing with you, standing next to you, whenever you are engaging in the GST legislation of this country. Friends, it is my privilege to speak to you, and I thank the Regional Council headed by Digital today to be with you. And once again, greetings to all of you. Thank you.
Thank you so much, sir. I thank you on behalf of Dungar Chand Jain, sir, for acknowledging and appreciating the efforts that have gone into this grand event with a lot of digital collaborations. Thank you so much once again, sir.
We now request the speaker, Advocate Rohan Shah, to start his session. Over to you, sir.
Thank you very much. Thank you to the association itself for this invitation and honor, and to the preceding speakers for their introduction and opening remarks. I have about 40 minutes till our designated time, so I will try and use that in a manner where I can bring to you a few thoughts in relation to the topic of input tax credit, while also sharing a legislative perspective and the perspective in terms of how writ courts have sought to shape this debate in the context now of GST and even under the earlier laws. If we go to the next slide, this is what I intend to cover in the day and in this session, but it would be important to first frame the issue for consideration in the context of saying, when we consider what is the objective of indirect taxation, which typically is a multi-point taxation, because in every commercial transaction, from the sourcing of raw materials through the process of manufacture till the point of ultimate retail consumption, you are going to have different links in the entire chain of trade. And therefore, if you have a tax like a GST, and that is a tax which is upon the event of a supply, then at every event of supply, that means that every link in the chain, you are going to have an event of taxation. Now, if your tax rate is to be effective, then it is critical that at every stage in the transaction which take place throughout the chain, you are only taxing the value addition which is occurring in that relevant link in the chain. And if you are only to tax the value addition in that link in the chain, then the mechanism that you need to avoid cascading taxes or tax upon tax is that you need a robust and complete input tax credit mechanism. And what the tax credit mechanisms in all indirect tax systems around the world seek to secure is that they become an instrumentality to ensure that there is no tax on tax or there is no impact of a cascading impact on tax. Because the accepted economic and legal principle is that tax on tax creates inefficiencies in the system, and tax on tax creates a higher cost of consumption, which is always anti-development. So that's the whole purpose of what we seek to achieve in terms of an input tax credit mechanism. Next. If we were therefore to apply this threshold in the context of the indirect tax regime that we had before, we know that we had a division of taxing powers, center and state. We also know that taxes, whether at the central level or sometimes even inter se in the central level or center and state, all of these essentially did not result in a credit, and there were several taxes which were paid which were not capable of being credited against the tax liability on the next transaction. And as I've tried to sort of exemplify in this chart, there were numerous instances and circumstances in which our system was extremely inefficient, and the inefficiency of that system really caused us tax on tax, and that caused us to have a very high mean level of taxation, much higher than what were our actual rates of taxation in the different tariffs. Next. The cascading impact of taxes of credit not being available when paid under one tax silo against another tax silo was also in a manner exaggerated by the fact that we had some blockage of credit. Namely, we didn't allow credit in certain circumstances or in certain transactions or products or services. And as a result, whether we looked at it in the context of the SENVAT credit rules or whether we looked at it from the perspective of credit under the VAT laws, what you had is several taxes paid which just did not result in a corresponding credit. And as a result of that, even though in several of our taxes, the mean rate could have been 18% or 24%, the effective tax burden of indirect taxes in India pre-GST was calculated at 31%. And if that was so, we were really almost at double the rate of taxation, which was the mean taxation rate in all the other developing countries taken as a whole and calculating their average. And obviously that had repercussions in terms of our economy. It is in this background that we came into the GST. And if we see the next slide, in the GST, one of our main ambitions was to remove the cascading effect of taxes. And that is thematically something that we discussed from the very first time that we even spoke of a GST or conceptualized a GST. But that as a common theme ran across all of the major policy statements as to why a GST was desirable. As many of you know, GST had critics who felt that it was not the right tax for India. And one of the reasons to propose the GST was not only that we would get to a singular or unitary tax, but one of its great merits, we were told, is that it would avoid the cascading impact of taxes. So quite clearly, we came to the GST in the hope and belief that cascading impact of taxes would either be eliminated or significantly reduced. Now, one of the issues which has sort of come up, and yes, we can go to the next slide. One of the issues which has come up is what is the true nature of the credit mechanism. And if we look at the leading judgments of the Supreme Court prior to the introduction of the GST, then Aisha Motors, effectively, the Supreme Court came to us in 1999 with the basis that the moment you paid a tax, you had an accrued right to credit, and that this accrued right to credit would continue up until the point in time that you were either able to take the credit or that the relevant goods, in that case it was dealing with goods, just didn't exist. Now, similar views in the context of Daiichi Karkarya, but there the Supreme Court went even further and said that in the mind of the Supreme Court, once tax had been paid, your right to credit was indefeasible. We had a further extension of that sort of an approach in the case of Ashok Leyland, where again it was said that you have a basic and intrinsic right to the credit once tax is paid. And while you can have procedure, the procedure should not in any manner impact the substantive right to credit. So if we see the law as declared by the Supreme Court, and which should therefore have been the settled law that we took forwards, the whole basis was that you had an indefeasible right once you effectively paid the tax. Now, I often give this analogy when I am before courts, that once you have paid the tax, if we consider that in an everyday analogy, it's like a person has breathed in. Now, once you take your breath in, the ability to get credit is almost like the natural function of breathing out. So that as you breathe in, which is the tax payment, you must have the right and ability to breathe out, which is the mechanism to take credit. And to the extent that we say under our legislation or under any interpretation that you can breathe in, namely you can pay the tax, but breathing out is conditional, restricted, deferred, contingent. All that we're doing is really creating a distortion in the system of the taxation, which will result in an unhealthy system of taxation, just as would happen if you allowed a human being to breathe in, but you had all sorts of restrictions on their breathing out. Now, as we moved into the GST, we would have expected to have a completely robust mechanism for credit. But as we will see, we still continue to have not only a series of restrictions, we have also very widespread litigation with people fighting desperately as assessees to say that I must have a full and robust right to credit. Next slide. As most of you know, our constitutional structure effectively was that under Article 246, we had a division of power of taxation. List 1 items fell within the taxing domain of the center. List 2 items of the 7th schedule fell to the state. Then we had a concurrent list. And to facilitate the GST, we actually brought in a significant amendment into the Constitution, which was Article 246A, where we tried to create now a new system constitutionally, apart from the entire list A, list 2, list 1, list 2 type system of silos in which taxes could be imposed. And one of the reasons for this, besides facilitating the levy, was also to facilitate the credit mechanism. Next slide. Very simply, and all of you are practitioners, and I have no doubt you are practitioners of great proficiency, but just to sort of create context, the situation in terms of the basic scheme of credit, of course, is set out in section 16 of the CGST. If you are a registered person, input tax credit is available to you. If the goods or services in question which are tax paid have been used or are intended to be used in furtherance of business, business in turn is under section 217, extremely widely defined, to not only encompass the business per se, but all incidental or ancillary activities, either pre, post, or in parallel. So for example, if you had effluent treatment, if you had subsidiary activities, everything would be regarded as business. And then we of course provide that there is a availability of credit. It is, however, subject to conditions or restrictions as may be prescribed. And from a classical perspective of a situation where you would expect that every rupee of tax paid should have become a rupee of credit, the fact of these conditions and restrictions which could be brought in really is the starting point of what I would regard as some of the distortions and anomalies. Next slide, please. Now, if we further analyze section 16, what is it that you need to be able to avail the credit, and what are those conditions? One is you do need a tax invoice or a debit note. You should have received the goods and services in question. The value of the supply should have been paid to the recipient, because you want to show a genuine and legitimate business transaction on which credit is claimed. The tax charged in respect of such supply should have gone to the revenue department or to the government. Your returns should have been appropriately furnished within the time limit specified. And you ought not to have had a double benefit in relation to capital goods of your income tax, benefit of depreciation, and also the ITC. Now, all of these as conditionalities are reasonable and expected conditionalities. They are all conditionalities supportive and promotive of a credit mechanism with the right sort of checks and balances to ensure that we do not have non-genuine transactions, of which a lot is being currently written about in the media, where we do not have sham transactions for the purposes of availment of credit. So this as a set of conditions has always been there. These are seen as perfectly legitimate conditions as checks and balances in the context of taking credit. Next slide, please. However, we now move to a situation where beyond these conditions, we now get into a more contentious terrain, the first of which is those credits which are completely blocked or in certain instances burnt out in the context of section 17.5. And there are a series of these, but the ones which have been most contentious, one has been goods and services for the construction of immovable property on own account. And we've had a series of litigations on this, and I will deal with that in the next few slides. And then the entire situation of works contract services for construction of immovable property. But the fact that, this also includes certain contentious issues, like when you use hired cars or leased cars, or where you offer certain perquisites or benefits in the context of what might be legitimate business activities. Next slide. Under the scheme of 17, of course, we continue the legacy of what we had even in previous SENVAT regimes or other VAT regimes for input tax credit. One, you can only get credit for those inputs or input services which you use for your business, and therefore non-business purpose consumption doesn't qualify. The other situation is, to the extent that you have a rendition of both taxable and exempt supplies, there is a certain amount of restriction. You need to maintain under 17.2 a different set of accounts. And then under 17.3, we have the formulation of a formula based on which your entitlement would be determined when you have both taxable and exempt supplies. And in that particular formula, we include in determining what is exempt certain specific additions, including additions in relation to those transactions where you suffer a reverse charge. We also have certain specific provisions for the banking industry, and which is 17.4, where we have the provision to say that they could take credit to the extent of 50%, and the remaining 50% is considered lapsed in the context of how that particular provision works. So you elect to choose this particular provision, you would get 50% of the input tax credit as a benefit in a month, but the rest of that credit would effectively lapse. Next slide. Now, one of the key issues in the move to GST was, how do we transition credits? Because there were many situations where I could have already paid tax, and the question was, how do I move those credits across into the GST regime? And one of the key sets of litigation which has come up is in the context of Rule 117, where a time limit was provided in terms of filing the GST Tran 1 to claim the credit. The issue which came up is that, is the prescription of the time limit mandatory? That means it has to be followed, or is it directory, which means even if it is breached, your substantive right is not affected? And the issue crystallized to say that, should you be denied credit even though there is no controversy that you paid the appropriate tax, merely because you did not file your Tran 1 within time? And in the context of the precedents, we actually see a mosaic of very different views from different courts. So Gujarat High Court, in the context of Willowwood Chemicals, took a view that 117, to the extent it prescribes a time limit, is not ultra vires. And they took a view that while you may have an inherent right or an indefeasible right to credit, the government was always capable of imposing reasonable restrictions, which included a time limit, and that it was important to bear in mind the concerns and sensitivities of the state exchequer or the revenue department. On the other hand, the Punjab High Court in Adford took a very, very clear view that if you deny credit in terms of tax paid, you actually violate Article 14 and Article 300A. 14, which would mean that the assessee is being discriminated against. 300A, which means that the property of the citizen, namely the assessee, has been taken away without following the proper process of law. And the fundamental philosophy was, assessee has paid tax, he has a right to credit, which would therefore enable him to do his business in a manner which is cost efficient. By imposing a time limit and therefore imposing a burden on him, you are acting contrary to the constitution. Punjab High Court therefore said that 117 is not constitutional. This went up to the Supreme Court. The SLP by the department, tax department, was dismissed by the Supreme Court. In Bombay High Court, in Nelco, the view taken was that 117 is not ultra vires, it is maintainable and good in law. The view they took is that ultimately credit as given is a concession, and any concession given by the government can be regulated by such conditions it considers appropriate. This has, of course, again gone up to the Supreme Court. And then we had the judgment in brand equity, where the Delhi High Court sort of took a view that credit is in fact a accrued and vested right. It relied on the Aisher and the Daiichi judgments. And they said that 117 must be read to say that the time limit is at best directory and procedural and is not mandatory. This again has gone up to the Supreme Court, and the judgment has actually been stayed by the Supreme Court in relation to this. So what we're seeing is that at the level of the different high courts, we have two courts which have said that the provision is ultra vires. We've had two courts which have said that the provision is sustainable in law. And ultimately, the final word on this will be spoken of by the Supreme Court. Next slide. Now, in the context of this, even at the level of the courts, we then had to deal with a retrospective amendment which came in, because one of the issues was that in the provisions themselves, that is 141, there was no contemplation that you will provide a time limit. And if there was no such contemplation of providing a time limit, then any time limit as imposed itself would not be legal. We therefore saw a amendment, and this is now a series of retrospective amendments which have been brought into the GST law. This is one of those where the amendment took you back in the context of saying that in the context of the time limit, this could be imposed. So they filled the gap and the criticism that you did not have a primary power to impose a timeline. That provision came up before the Madras High Court in the case of PR Money Electronics. In that particular case, they upheld the provision to say, look, now there is an empowerment to impose a time limit. There is then a subsequent matter which is now pending in the Madras High Court, which is the uh, Amplexor judgment. And in the Amplexor case, the matter is pending. And if we see the next slide, various important questions have been framed before the Madras High Court. The three key ones being whether ITC is a vested right, and whether any restriction of time is constitutionally permissible, whether Rule 117 is mandatory or directory, and whether 140 can divest the right to credit, which has already accrued on the fact of tax payment. There's also a argument that every assessee has a legitimate expectation, especially when they paid tax under the old regime, that they will get credit in the new regime, and that particular legitimate expectation has been denied. Next slide, please. So one controversy we've had is the one I just mentioned in terms of 117. We've also had a controversy before the courts in relation to the credit on cess. And under section 140 sub 1, the provision of credit was that the Senvat credit balance, as per the last returns, would be allowed and would be carried forward. Question came up whether that also includes the cesses. The law was amended to clarify that the cess balance would not be allowed. The question came up whether this is constitutionally valid. Again, in these situations, we've seen that in the case of Sutherland Global, the Madras High Court took a view that a accumulated cess credit has been denied, and that the court held that the various cesses are not covered because there is a definition of eligible duties which were permitted under section 140. If it was not covered there in the wisdom of the legislature, then you had effectively no right. On the other hand, when the matter came up before the Cestat in Delhi, a view was taken there that there was an inherent and entrenched right even in relation to the cess. And if credit was not available, then effectively a cash refund should be given. We've also had a proceeding for Grasim before the Gujarat High Court. Notice has been issued. We are still to see the final judgment. But again, the issue sort of taken up over there is you had the cess as part of the credit mechanism earlier. Can you, in a transition, deny what was already a right available under the old law, especially when the undertaking was that we will help you transition all your credit. So this now is the second stream of the ITC related litigation which pends before courts. Again, in the context of the transitional credit itself, issues arose under section 140 sub 3. And the issue then was that you were in a position to claim your credit, but the provision said you could only claim it in respect of invoices which are not then more than 12 months old. This was a new provision. There was no such provision previously. And again, issues were raised before the writ courts. Bombay High Court in the case of JCB said that the imposition of the condition that invoices should not be more than 12 months old could not be regarded as an unreasonable restriction, that it was not unreasonable or arbitrary, and that even the old SENVAT scheme had some conditionality. However, Gujarat High Court in the case of Philco took a view to say that this was an unreasonable restriction, because once it was established that the tax had in fact been paid, now to say that you would lose credit if your invoices were more than 12 months old was to bring in a completely new and unanticipated condition, and that was an unreasonable restriction which was arbitrary. And as a result, they took a view that the provision which imposed such a condition was unconstitutional. Again, the Philco matter went to the Supreme Court. We have a stay from the Supreme Court in the context of the Philco view. So this again is an issue which travels to Supreme Court, another stream of contentious issues, and is part of the group of these matters which Supreme Court will now consider over time. But in the meanwhile, of course, we have day-to-day issues where the assessees have the uncertainty on what it is that they're required to do. Shall we go to the next slide? Now, in the context of the transitional provisions, let me deal with one of them, which is 140 sub 7, where you dealt with a situation where you have a non-obstante clause. The clause begins once section 140 sub 7 begins with the word notwithstanding. It is non-obstante. That means no procedure or condition under 140 should stand in the way of this credit. 147 sub 7 allows you in the context of an ISD to be able to transition the credit and distribute the credits. That is the provision of law in the Act. However, when we come to the procedure, effectively what we find is that originally you couldn't bring in this credit into your Tran 1. Then the Tran 1 was modified to also accommodate your ability to bring in credit under 140 sub 7. That having been done, the next issue was I had to distribute this credit to the various locations. That distribution could only have happened through the GSTR 6 mechanism or under the Tran 1 mechanism. The Tran 1 didn't offer any such ability, so I had to look at the GSTR 6. But in the GSTR 6, the only thing that could effectively have been taken up was such credit which was credit only under the GST regimes, because the form of what could be accepted as credit in the GSTR 3 was only the GST credits. And as a result, the entirety of what I should have been able to transition under 140 sub 7 was effectively lost. Now, this has come up as writ petitions. We have a pending petition in Mumbai that I'm arguing. We have other petitions in Delhi and Telangana. But again, this is one of those instances where the section enables the credit, but the procedure in a manner fails the credit mechanism itself. One of the recurrent issues which has been coming up in terms of 17.5 and the blocked credits has been that there is a blockage of credit in relation to whatever is utilized in the creation of immovable properties. And immovable properties which are to be used on your own account, you are not able to take that credit. But you have several situations where a immovable property may itself then be used to create further taxable supply. For example, in an office premises, you will create further taxable supplies of rental. In malls, you will create further taxable supplies again from lease or rental or revenue share arrangements. And as this has come up, we've had one ruling, which is the Safari judgment of the Orissa High Court, where they have said that it is unfair to deny credit in such situation. And they have advocated a reading down of the provision to say that the only way that you can save this provision is to read it down, namely that if there is a further taxable outward supply, then there should be no denial of credit. Now, on this issue, of course, now we have a profusion of writs, all pending. We have some in Mumbai, we have some in the context of Gujarat, Delhi, Calcutta, and therefore all of these will sort of again effectively surface. Uh, Next slide, please. We also have had this rather peculiar situation where there has been a denial of credit while prescribing a lower rate. This has happened for the restaurant sector. This has also happened in the context of real estate. So what did we have in the context of restaurants? You had a 12% levy with credit. However, when you prescribed 5% on the 14th of November 2017, you said that this 5% will come with a complete denial of credit. Now, there are many situations where the taxation is you have a levy of 12% with credit, but you could opt for 5% without credit. So for the taxable supply in question, you have both options. However, in real estate and restaurants, they completely took away the option. And in the guise of prescribing a rate, they actually burnt out the credit. Now, there are writs again challenging this situation. I am concerned with one of those in the Gujarat High Court, where the challenge we've made is that in the guise of prescribing a rate, which is part of the levy mechanism, you cannot affect the availability of credit under Section 16. And that Section 16, you can only deny or make credit conditional in the manner prescribed. And prescribed means by legislating rules, not by bringing in a rate notification. So here again, we see industries where the entirety of their credit availability has been completely denied because of the approach which was taken in giving them a lower rate of taxation. Next slide. Another interesting issue has been this whole issue of inverted duty structure and the related refund mechanism under Section 54. And if we see 54.3, the credit which you should be able to treat as the credit eligible for the refund, the section talks of a availability both qua inputs and input services. However, when we look at the relevant corresponding rule of administration, which is Rule 89.5, there we find that by a retrospective amendment, what has been done is that the credit mechanism is only restricted to inputs. Input services which are clearly contemplated by the section are not permitted by the rule. Now, again, this got challenged, and almost expectedly, we have two viewpoints. In VKC footsteps, Gujarat High Court clearly took a view that if the section permitted the right of refund on accrued credits where you have an inverted duty structure, both on input and input services, then 89.5 as a rule, being subsidiary and delegated, could not have restricted the credit available under the section. When it came up before the Madras High Court, however, in the TVL, the AFSCON's case, the situation is they said, no, this is a restriction. There is justification for this restriction. And no matter what the text of 54.3, the situation is that the restriction which is brought by 89.5 cannot be said to be contradictory or uncontemplated under 54.3. So again, we have two opposing views. As a result, we have a series of writ petitions now. We have at least a batch of 6 of them in the Bombay High Court. We also have a batch of them in Delhi. So again, this is another issue which is sort of bubbling over in the context of the ITC. Next slide. There have been various procedural bottlenecks also. And, amongst those, your section 16(2)(c), where you deny ITC to the recipient if the tax charge has not actually been paid to the government by the supplier. Now, again here, writs have been filed. There is a principle of equity which says that I can't vicariously be liable if I have paid the tax. Then I should have had some ability to the credit. The fact that some other party has defaulted or has not complied in some form or manner should not effectively deny me. There is a challenge again on this before the Gujarat High Court. We also have a challenge in Delhi in the case of Arise India, where not only do we deal with the GST provisions, but we also deal with the broader, more equitous principles of whether a breach or a failure by a third party should deny me my substantive right when I have reimbursed the tax. Next slide. We also have in this bucket of the procedural issues, the Rule 61 issue and the form GSTR 3B. Again, we have the challenge in relation to Bharti Airtel before Delhi High Court, challenging the vagaries of Rule 61, saying that, look, if there is a genuine mistake, a correction should be permitted no matter what the time. As long as it's a genuine correction, you cannot deny me to say that if I make a mistake and I haven't corrected it within a certain time period, then my right to correct the mistake is effectively lost forever. Delhi High Court came down in favor of Bharti Airtel, said yes, once it was proven that you had a genuine mistake, you should have a right to correct. The law cannot restrict that. That again now goes to the Supreme Court and is pending in the Supreme Court. Next slide. Again, in terms of sub-rule 4 of 36, the restriction of 10% previously was 20%. Again, as all of you know, this has been seen as being restrictive and unfair. A series of writ petitions have come up on the basis that even the 20% restriction was unfair. Now taking it down to 10 further augments and exaggerates that. Again, a series of petitions in different courts in relation to this. Next slide, which I would think is probably about the last set of issues that we have. No, we've reached actually our last issue. So if we go to the next slide, and which brings me then to the end of my presentation, the only thought that I would like to sort of leave you all with is that the system we wanted to attain is a system where all taxes paid would result in credits, that we would get over litigation and we would get over the cascading impact of taxes. And GST was our great big hope in terms of achieving that. And I think while getting the GST into our country has been one of the most outstanding tax developments since we became a nation, the fact that we still have a ever escalating amount of litigation on ITC is a concern. You had the Honorable Finance Minister speak to you all yesterday. You all are obviously a very, very powerful body whose voice I understand is heard by important people. And I think one of the big messages that you all can take for us to get a world-class GST and for our assessees to feel that they are in a world-class taxation system in GST is that we need a robust and complete credit mechanism which does not foster litigation, but which fosters economic activity. And with those words, I'd like to conclude. Thank you very much for this opportunity. And it's always a pleasure to come speak to this forum. And I wish you the best for the remainder of this conference. Thank you very much.
We thank you all very much for taking time away from your very busy schedule, sir, to take us through this very informative session. You have simplified and elaborated on a very evolving topic that, can I say, has been a challenge for many of us. Thank you so much for your time.